Everyone on YouTube says just buy SCHD. Nobody talks about combining it with FDVV, and that might be a mistake. Because when you layer these two dividend ETFs together, something interesting happens. If you're investing $5 a day like I am, this could be one of the simplest ways to increase diversification, strengthen dividend growth, and keep things boring in a good way. Let's break it down. You already know SCHD, the Schwab U.S. Dividend Equity ETF, dividend growth, quality companies, strong balance sheets, reliable income. It's basically the foundation of modern dividend investing. Then there's FDVV, the Fidelity High Dividend ETF, higher dividend focus, different screening model, more tech exposure, slightly different weighting system. Most people frame this as SCHD versus FDVV, but I don't think that's the real conversation. The real insight is this. They're not identical. Yes, there's overlap, but the methodology is different. SCHD filters hard for financial strength and dividend consistency. FDVV casts a wider net on high dividend payers and high growth expectations. When you combine them, you're blending two different dividend philosophies, quality plus broader exposure. That's powerful. Now, I know what you're thinking. Aren't you just doubling up on the same stocks? Not exactly. Sector weighs different. Position sizing differs. Rebalance timing differs. This means concentration risk gets smoothed out. Instead of one ETF dominating your exposure, you've got internal balance built in without adding 5 different funds. Let's keep this simple. If I invest $5 a day, I could alternate day 1 SCHD, day 2 FDVV, or split contributions 50-50. But now I'm building dividend growth from SCHD, broader high-yield exposure from FDVV, sector diversification, long-term compounding. And I still only own 2 ETFs. That's simple, that's scalable, that's sustainable. Here's the real reason this combo doesn't trend on YouTube. It's not dramatic. It's not 10% yield. It's not retire in 5 years. It's disciplined, it's balanced, it's boring. And boring strategies don't get clicks. But boring strategies build wealth. Think about portfolio structure. If SCHD leans heavier into industrials 1 year, FDVV's tech exposure might counterbalance that. If one underperforms during a sector rotation, the other might cushion the impact. That's diversification without complexity, and that matters when you're consistently investing every single week. Dividend growth investing isn't about next month. It's about 10, 15, 20 years. If both ETFs continue growing dividends and you keep reinvesting, you're stacking income on top of income. That's how passive income snowballs, especially when you're consistent, even at $5 a day. Here is both FDVV and SCHD in my portfolio. As you can see, FDVV is up 35.32% for me, and then SCHD is 23.49%. That is what I am getting in dividends. FDVV is 86.66, while SCHD is 106.38, and that is after 3 years. So maybe the better question isn't SCHD or FDVV. Maybe it's why not both? Drop a comment. Would you combine them or just stick with just one? And if you're building passive income one small investment at a time, subscribe. We're tracking this in real time. If you find value in what I'm saying, please like, comment, and subscribe. Remember, I am not a financial advisor. Investing involves risk, and past performance does not indicate future performance. Again, if you find value in what I'm saying, please like, subscribe, and comment. I do have other videos in my $5 a day series: QDTE, QQQI, GDXY, SPYI, and CHPY. Please feel free to watch them, comment, let me know what you think, and thank you for watching.